I think retirement, a lot of times is the day that you quit your job. But I think, hey, when are you financially free enough to show up to work because you want to have the engagement, you want to have that community, not because you feel like, okay, I've got to get another paycheck to make the mortgage payment.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And Eli.
As always, happy to be here.
As always. Eli practices that.
He does.
So excited to be here today. Got a good conversation started. So we're going to start doing something, I guess, new or a little more structured each week, where we talk through one topic or one question that we get a lot. So whether it's in client meetings, prospect meetings, emails that we get from you guys, or comments in the chat, just stuff that we're consistently coming across and seeing. So today we're going to kind of start that off. So moving forward each week, we're going to kind of hit on one of these common themes that we're seeing consistently. Today we're going to talk about just kind of the broad general question of, can I retire early? So we have a lot of people we work with, retirees, people trying to retire, building plans for people. So we get this question all the time, like, when can I retire? Can I retire early? So we're going to talk through that a little bit. I think the first thing to mention is, early is defined different for everybody.
Mm-hmm. That was the first question I was going to ask is,
like,
early meaning, before 59 and a half, before Social Security, before Medicare. I mean, what is your definition of?
Yeah, if you're 60 and you're asking that question, right, it's probably like, hey, can I retire at 62 instead of waiting to 65 or so? But if you're in your 40s, you're probably thinking, oh, could I retire at 50 or 55 instead of waiting till 59 and a half or 62?
When Eli mentions it, it's, can I go home this afternoon? Yeah. I mean, it's like, the definition depends on who's asking.
No.
Yeah, so it's a really good question, and you kind of have to know, what should you be looking at to help you answer that question, so that you're not, people like us, advisors, planners, can help you, run the calculations and the projections and the forecasts on how realistic is it, how far off, are you on track? But you also want to be, knowledgeable enough yourself to kind of come to that conclusion and decision on your own. So what are some things that people should be aware of or looking at when they're trying to answer the question, can I retire early?
Well, the first thing that we talked about before we get into the technical aspects, we discussed probably the most important part of can you retire early is, do you know what you're going to do in retirement? If you don't know where you're headed, retirement is going to be horrible.
Yeah.
There's actually a term called Great Depression, and it's for the people who are in that stage of retirement. They lack the purpose, they lack the meaning. There's not something that they're going to do, so they fall into this form of depression because there's just not a purpose for their everyday lives.
Yeah, we were built, not to get overly scriptural here, or not that that's a bad thing, but we were created for work, right? And we were created to have a ppurpose and to live out that purpose, and work in and of itself is not a bad thing. I think I try to encourage people like retirement should be because, you're going to do something you want to do, not do nothing, and Mike Frost, shout out to Mike Frost, former advisor, used to always say, what are you retiring to? That's just as important, if not more important, than what are you retiring from? And I think that's a really good kind of perspective makes you think well, shoot, I don't know. I just want to stop doing what I'm doing now. But that's probably not enough.
Yeah, it's worth all of the time, energy, and effort that you put into building a career and deciding on your career and then continually setting new goals while you're within a career. It's worth doing similar activities for retirement.
Sure.
Mm-hmm. Because if you can find purpose in retirement through social connections, through something like volunteering, wherever you can find that purpose and setting goals will keep retirement worth something to you.
And I think there's a difference between voluntary retirement, when you can plan.
Sure.
Versus this involuntary retirement to where it's been somewhat thrust upon you, and those planning stages that Mike's talked about and so forth, they're really consolidated, and you don't have that time to think and to plan. We were talking before we went on the air, but the 5 stages of retirement: pre-retirement, planning before the honeymoon phase. Woohoo! I don't have to get up in the mornings and set an alarm clock. Disenchantment is a very real thing. Reorientation, and then stability. So that is a process that every retiree typically goes through, and some quicker than others, some easier than others, but it is a process, and it's it can take a toll, and it's not easy.
And go ahead.
The one that I've probably seen more than anything in the disenchantment phase is lacking involvement with other people. Finding that they're doing more and more activities that are solo or self-dependent, and not being involved in teams or
community.
A community.
Yeah.
We're living that right now as a personal example, and we've talked about it here at the office. My wife retired a couple of years ago, and just this past weekend, we're 2.5 years removed, and she is still saying she misses the people. She misses the collaboration, getting together with like-minded peers, and 2.5 years later, that part of the retirement process, she may still be in that disenchantment phase. So it's a real thing.
Yeah. Yeah. And I think, retirement for me, when I think of retirement, is, getting to the point where now you're working because you want to, not because you financially have to.
Yeah.
So I think retirement, a lot of times is the day that you quit your job. But I think, hey, when are you financially free enough to show up to work because you want to have the engagement, you want to have that community, not because you feel like, okay, I've got to get another paycheck to make the mortgage payment. So it's a really good, basic, we always talk about it, but have a plan. I've seen it, and I won't call out any names because that'd be super awkward, but I've seen it firsthand over and over again. Like clients who retire, especially retire earlier with no real plan, they age faster. They don't stay as sharp. I mean,
their health deteriorates.
I almost hesitate to say it, but they legitimately look older much sooner. Not that looking older is a bad thing, but I think you genuinely age quicker if you don't have some form of routine purpose, and something keeping you sharp, making you use your brain, making you, communicate with other people.
So what's so interesting about this conversation, and we're asking a question that a reader brought to us, is that we've spent 10 minutes talking about it, and so much of it is non-financial.
Yeah.
It has nothing to do with how much you have in the bank and how much you have in your investment accounts. And there's such a bigger portion or a bigger part of this decision. Can I retire early?
So that's a lot of the intangible parts. If we can, let's switch over to some of the more tangible ideas and aspects around kind of how you should be planning or thinking about a few parts of planning in retirement. And the first thing that comes to mind is, where's your income going to come from? So you've been working, you've had a paycheck every single biweekly, monthly, however your paycheck came. Now, where's your paycheck going to come from? And do you feel that paycheck will be secure or stable enough to last for a good life expectancy? People are living a long time now.
Right.
So into your 90s, can that paycheck continue towards that?
Yeah. 40, 30, 40, 50 years.
Yeah. As you near retirement, I mean, the calculation quickly, evolves from an accumulation, compound growth kind of strategy to now it's a cash flow equation. Do we have enough cash inflow to take care of the cash outflow, and is that sustainable? So to your point. And so it does change things. It doesn't mean you need to invest completely different, but you probably need to invest a little bit different than you did.
And if you're looking at really early retirement, then where your income comes from, the account matters.
Sure.
So if you're looking at pre-59 and a half, then if all of your money's in pre-tax 401k IRAs, there are ways to get it out, but they're pretty complicated.
And it gets tricky.
It gets very tricky very fast. Yeah. And so if you're planning and you're expecting, okay, there's a chance that I could be retiring in my 40s or early 50s, then you have to start caring about your account structure.
Right.
Are you investing all in 401ks, or can we start moving money outside of a 401k?
Yeah. Yeah. No, there's a lot that goes into it. Tax planning, health insurance is probably one of the biggest ones that I see.
What the heck am I going to do for insurance?
And that's retiring pre-65. So that's not even like early, right? I mean, even if you're retiring at 60, 62, you've got to have a plan for health insurance, and that's a really hard one.
And in many times,
expensive one.
I was going to say, in many times, it's the single biggest expense that you're going to have, aside from if you still have a mortgage.
Yeah. So
in planning around health insurance, the thing that I encourage people most is don't let this increased cost stop you from doing what you really want to do.
Right.
So yes, it's painful. Yes, if you're not able to get subsidies, it's going to be really expensive. But if the plan works, it works.
Yeah.
And don't let that increased cost, just because it annoys you, stop you from doing what you really care about.
100%. Yeah. Yeah. I've talked to a lot of people in the past about this natural tension as a believer and an advisor of knowing that we're called to be good stewards, prepare for the future, but also knowing we're not guaranteed tomorrow.
Right.
And like reality, I think for most people, and kind of the healthiest spot lies somewhere in the middle, where we're living both well, right?
Mm-hmm.
Planning, being good stewards, but also not sacrificing today and tomorrow for something that's not guaranteed 20 or 30 years in the future. And so I talk about that a lot. I jokingly, I say with clients a lot, like I feel like a lot of times I'm talking to clients about, hey, you need to go spend more, enjoy these. Like you did a good job planning, you did a good job preparing and doing what you're supposed to do. Like money's just a resource. Like use it for good, live life. Because sometimes it can be hard to transition from a paycheck to, now we're actually spending this money.
Yeah.
And that's a hard transition for a lot of people. So
one of the other tangible things that you should consider is, are you overinvested in single assets? Do you have all of your money in one stock? Do you have all of your money in one rental property?
Sure.
Or are you making sure that in different market economies that your portfolio can sustain the income that you need?
Yeah, there's no such thing as guarantees, right, in the market, but you can get yourself closer to risk-free, knowing that's never achievable, but you can get closer the more diversified you are, right? And the less you're exposed to one singular event, one particular, risk with a particular company or asset class. And so there's a lot of ways to diversify, both on the investments, but also on the income streams, right? So we talk a lot, like I was saying earlier, retirement is a cash flow equation. So can we diversify our income streams so that's consistent and steady versus being overly dependent on any one source. So really good topic. Kind of a fun way to start the conversation with.
So to sum it up,
yeah,
it depends.
Yeah.
Yeah. Sum it up. Everyone can retire. It just depends what you want to live off of.
And a lot of people can retire with much less than they think if you're debt free. If your lifestyle is reasonable. I tell people...
if you're willing to move countries.
Yeah.
Yeah, correct.
I tell people a lot, though, it's like, can I retire? I'm like, yeah, but you're not going to have as much flexibility in what you spend in retirement.
Right.
So now it's just deciding, would I rather work and give myself more flexibility on income, or would I rather stop working and know that it might be a little tighter, but I can still maybe make it work? And those are just, no one can answer that question for you.
Correct.
You have to answer it for yourself. So a lot of good things to talk through. So we're going to transition from that to a super, super exciting topic about taxes. Capital gains taxes. So Eli's going to walk us through. We actually had this conversation in our advisory meeting yesterday. We have regular meetings with our entire advisory group, just talking through, different topics, different planning conversations, products, things out there. Sometimes it's just refreshers, and sometimes it's brand new information, even for us. And so Eli was walking us through kind of a refresher on capital gains taxes yesterday, because it's something that we can, I think, often oversimplify, and it is a little bit more complicated. So talk us through how capital gains work.
So capital gains are on a sale of an asset that's not in a retirement account. So you own a stock, or you own a property, some form of asset that's outside of a retirement account. You purchased it for a price and you sell it for more. That difference is the gain. So you purchase something for $100,000 and you sell it for $150,000. you have a $50,000 gain. Within capital gains tax, it is the same thing as your marginal income tax. So as you earn more, you pay more in tax. The same is true in capital gains tax. Excuse me, my throat's acting up on me.
You're good.
So if you are single, making less than $48,000, or married, making less than $96,000, you actually don't pay any tax on capital gains. So long-term capital gains, and that's an important clarification too, which I'll let you explain. But if you have a long-term capital gain and you're single making less than 48 or married making less than 96, you actually pay nothing on capital gains tax. And to me, that's an opportunity.
Sure.
If you have some wherewithal within those brackets to capture the gain, go ahead.
Yeah.
Pay 0% tax, increase your basis in that stock from 100 to 150. So
And
that
real quick, one thing though, you were kind of reminding us yesterday, that's based on your MAGI or MAGI income, not taxable income or not adjusted gross income. A lot of people, MAGI and AGI are the same or very similar, but it's not like taxable income after you've taken the standard deduction. This is like income from all sources, even if it's usually not taxable.
Yeah. So modified adjusted gross income is a different calculation than your adjusted gross income. But for all intensive purposes, you can assume it's more than your adjusted gross income.
Yeah, it typically won't be less. Yeah.
It will probably, I don't think it'll ever be less. I can't.
It would be the same, would be like
yes,
the work.
It'd be
like
the same. So that's the 0% capital gains bracket. The next bracket is still a pretty advantageous bracket to pay tax in. So the next bracket goes from 0% to 15%. And for single people, that starts at 48 and it goes up to 533,000 of income. For married, it starts at 96 and it goes up to 600,000 of income. So that 15%, if you're making 600,000 of income, you're paying much higher income tax, but your capital gains tax is only 15%. You're in the 30+% on income, but you're paying half of that if you capture a capital gain. So that's a bracket that's really a pretty great bracket to be paying capital gains tax.
And again,
in.
this is on long term. So those are assets that you've held for over 1 year.
You had to have held the asset for longer than a year. If you've held it for less than a year, then you pay your income
Just
tax.
normal income.
So here's a question for our listeners. Is capital gain included in taxable income? So
In your adjusted gross income?
correct.
Yes.
Okay, so if my modified adjusted gross income is
you have
50, it's 50,000. But I have that's from my salary. And then I have 100,000 of capital gains. My MAGI or my modified adjusted gross income would be, with everything else being equal, would be 150,000. Correct? Okay.
So that brings me to the next part of capital gains that I think most people misunderstand, and that's that capital gains is marginal. So say for that example, you're a married couple, and that bracket changes at 96,000, and you have $50,000 of income. So you have $40,000 roughly that you could capture in the 0% capital gains bracket. So your first $40,000 of capital gains, you would pay 0% tax on.
So it's like progressive. It's not all going to be taxed the same necessarily. It's
So then anything above that, then you'd pay the 15% tax on.
Okay.
So
good to know.
that's one thing that I think most people think wrong. They think I'm going to be in the 15%. It's all
it's from $1.
15%, and it's not. It's marginal up to that. So that's the general basis of capital gains. The only part that I would say starts to get more confusing is this thing called net investment income tax.
Yeah.
So net investment income tax comes in for single individuals making $200,000 and married couples making $250,000. If your modified adjusted gross income is over those levels, then you pay another 3.8% on top of the capital gains tax.
So to give your voice a break,
Thank
if you're in the 15% capital gains bracket, so let's say you made $300,000 as a married couple, so you're over the net investment income tax threshold. You're in the 15% long-term capital gains. You're going to pay 18.8% on capital gains, long-term capital gains, up to the like 600,000. Then after that, when you get into the 20% bracket, you're not going to pay 20%. You're going to pay 23.8%. Right?
So I jokingly say there's no such thing as a 20% capital gains bracket because anyone that's there is paying the NIIT tax at
Yeah.
23.8%.
Yeah.
Yeah. Okay.
That's really good to know, because I think even advisors just throw
Well,
that out.
you hear 15, 20%.
That's
It's
correct.
Like, or is it, are you paying long term, 15, 20, or is it short term? Normal, ordinary income bracket, right? And so that's, it is oversimplified for sure. And for some people it is kind of maybe that simple, but for a lot of people they're not going to pay as much, or maybe or pay more because they're not.
But even if you're in
aware
the
of-
15% bracket and you fall underneath the, what'd you call it, the NITI? If you're in the 15% bracket, you fall below the NITI threshold, then you theoretically will pay a little bit less than 15%, because the first.
Yeah, you might pay an
Portion is-
effective like 12%.
But
the
if
first
a
person.
married couple, because the 22% ordinary income bracket starts at 96,000 for a married
Correct.
couple filing joint, right? So, and that's like the same. It's like a couple $100 off of the top for the 15% for capital gains. So if you have a married couple filing joint makes 150,000, their marginal bracket is going to be 22%. So any new income up to 206,000 is going to be 22%. So that's why you hear like, oh, it is advantageous because you could pay long-term capital gains of 15%, but you want to hold it more in the year, because if you don't, you're going to pay 22% on it,
Yeah.
right? And so there's a lot of times where it makes sense to defer. You want to try to make it long-term versus short-term, but it's not always as black and white as you might think.
And if you want me to get really nerdy, there is this.
Can
Go
I say
for it.
no? Okay, no, I'm just kidding.
There is a window in which capturing short-term gain is better than long-term gain.
Is it the $200?
No, it's if you take into account the standard deduction of $30,000, the 12% bracket really goes up to 96,000 or 97,000 plus 30,000. So roughly 100. Oh, public math, 127,000.
Yeah. Yeah.
So you have up to 127,000 that you pay 12% tax on.
When you take into account the standard deduction.
Yes, but capital gains does not take into account the standard deduction. So if you're making between 96 and 127 and you capture a long-term capital gain, you pay 15% tax instead of 12% tax.
Yeah.
It's the only weird niche.
Yeah, there's some weird things there.
Interesting.
And the moral of the story is we should go to flat tax that you can fill out on an index card.
That'll preach.
Because this is one, as complicated as it can kind of be, this is one very
Sure.
simple part of our tax code.
Yeah.
And we've just talked about it for like 10 or 15 minutes of how
Sorry about
And,
that.
and we
No,
have
it's good.
we have congressmen up in Washington putting this together.
Yeah.
Yeah.
But it's really, really, really good information. We talked about it yesterday, like I said, in our advisory meeting. And so I had asked Eli, I was like, hey, this would be great to talk through on the podcast. So if you have questions, thoughts, comments, let us know.
Email Eli at. Well, it is good to know, and it like John says a lot in these podcasts. That's why we plan, and it's not one size fits all. I mean, everybody's situation is different. We take into account their income, their family situation, their age. The next 3.5 years, they get a larger standard deduction. So I mean, things are constantly changing, which require us to constantly look at people's situation and try to figure out what's best for them.
Well, I think a lot of people fall victim to, how can I get a 8% return versus a 7%? Which is fair,
Yeah.
right? We always want to maximize returns. But there's just as much value, if not more, long-term into asset positioning, capital gains management, tax planning. You can increase your net return to yourself in terms of money that you're going to actually have left over to spend just as much or more
Sure.
without having to try to increase the the return of your portfolio. So
And if all of your money's in qualified assets, then just ignore the last 12 minutes of our conversation.
yeah, which is a lot of people.
Yeah, it
a
is.
bulk of it is. So, well, we're gonna tie a bow on it. We've been talking for a while, but good conversation.
Good stuff.
Yeah, can I retire early? Good question. Just kind of as a summary, thinking through why. What are you gonna go do? What is early to you? How do you define that? And then talk to somebody. Talk to an advisor, someone who has skills in planning and experience there, and then capital gains taxes. Be aware of how those work and kind of the nuances with that. So as always, we appreciate you guys watching and listening. Give us a like, subscribe, email us, or comment with questions that you may have. Love reading the comments, even the mean ones. They're kind of funny. So appreciate you guys. We'll see you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.